of Equiti Capital. David, good evening. Thank you so much for taking the time. I'm looking at the 10-year bond yield, and it seems to have cooled off to about 2.74. Is that something that was anticipated? Is that something you're watching closely? Do you expect it to cool off further? And where do you see equities right now?
It is something I'm paying close attention to. What I wrote on my afternoon note yesterday was that in a strange kind of twist of fate, we saw the yield on the US 10-year government bonds tick down to 2.73%. It's its lowest level since the last week of April. And this was because the brutal losses that we saw in US equities yesterday, in particular technology stocks, that actually prompted traders to actually buy up government bonds and in turn put a bit of downward pressure on the actual yield itself. So it's a bit odd now that we're in a situation whereby bond yields are actually under pressure because there's nervousness in stock markets. When if you think about it, a lot of this sell-off that we've seen in stock markets over the last few weeks and months, particularly in the tech sector, was driven by the very fact that bond yields were rising. And it wasn't that long ago the US 10-year yield was north of 3%. And at this point, that was when, broadly speaking, stocks were under major pressure because people were thinking to themselves, the rally in the yield indicates that the bond markets are pricing in further interest rate hikes down the line. An increased bond yield essentially is a predictor for higher borrowing costs, which would obviously impact many companies across the board, but especially tech companies because they have relatively high levels of debt. So that's kind of precipitated the sell-off that we've seen in tech stocks in recent weeks and months. But it also has to do with the wider investment community. You know, a year and a half ago, 2 years ago, interest rates were essentially zero. Bond yields were either minuscule or, in many cases, negative. So if you had money to invest, the bond market or having cash in a bank account wasn't very attractive, and therefore the stock market was very attractive. Now the tide is turning. People are saying, well, we've already had 2 interest rate hikes in the US in a few months. It looks as if we're going to have another next month. Why have all my money tied up in equities, which are considered to be higher risk, when it could have money either in government bonds or perhaps cash in bank accounts?
Absolutely. I think that covers the current status quo quite nicely. Thank you so much for taking the time, David.